All right, and welcome to Trading Options, Creating Income with Options. I am Mark Sebastian. That is me right there with my friend Liz Clayman, who is very, very, very nice, and one of the nicest people you meet, actually. I was a market maker for about 10 years. After that, I got into the education and consulting business. I work with retail traders here at Option Pit, trying to help them become really, professionals, or at least think like professional traders. And then we also do a fair amount of consulting. I'll go into a hedge fund or a money management group or an RIA, and I'll help them either implement option strategies, or I'll try and break their option strategy to point out weaknesses and really do some stress testing and risk testing. I like to joke that I have clients with $1,500 all the way up to $15 billion. And the scary part is most of the time the guys with $1,500 far understand options better than the guy with $15 billion. Part of that is because the guy with $15 billion can afford to have other people. But that is what we are about. So here's what you will learn. All right. As many of you know, I'm the author of the Option Traders Hedge Fund, and there'll be some pieces of that book in this. But so in selling options, traders run their own insurance company. That's really what options are. Options are a form of insurance. All right. So I'm going to talk about how insurance make money, how options relate to the insurance business. So I'm going to set the table a little bit. How to identify under and overpriced options, how to generate position selection routine, conditions of volatility that produce optimal conditions for a trade, and I'm an example of a trade and how it fits. And then afterwards, if we have time, I'll look at a couple live. We'll pick out a stock and we'll try and find a trade that we think is good. All right, and my goal is to get done with the actual presentation in about 45 minutes or so. I'm not the type of guy that likes to take 2 hours to present. Insurance companies make money selling insurance policies to many, many individuals. All right, the idea is that only a fraction will redeem at any one time, and then they trade this float. All right. This leaves the insurance companies with excess capital to invest. All right. The risks are spread out over a large area. All right. They reduce their risk by buying insurance back in the reinsurance market. All right. So they write policies. They use the excess capital to invest, the float. They spread out the risk wide, and if they feel like they've got too much risk, they will reinsure. Pretty simple. This is my book, The One-Man Insurance Company, me and Dennis Chen, who was client number 2 at Option Pit, and what I kind of helped him with his hedge fund. He trades in Panama. Nice guy. I'm actually in the middle of writing my next book, and that's going to be another one on risk. All right, because risk is an important thing. I can tell you I've learned some bad lessons on risk. I know lots of other people have. All right, and I sat in on a presentation at the CBOE Risk Management Conference, and it was called the Blow Up Hall of Fame, and it was all these. It was an hour presentation about all these brilliant men that completely blew up their company. The guy that invented the Black-Scholes model blew up a company with billions of dollars. It was called long-term capital management. So some of the smartest people can blow things up. That's why understanding how your insurance business works and how to manage things is so important. All right. So options are like insurance policies. They collect dollars up front for obligations to pay at a later date. All right. Selling options generates a credit up front for taking an obligation of buying or selling the underlying security at a set price in the future. Let's compare. All right. So comparing options and insurance. Underwriting and pricing, that's the trade selection. Reinsurance claim and claims processing is risk management. Customer acquisition, trade execution, and of course trading is the investment operations. All right. So adapting option trading to the insurance model makes a ton of sense. All right. Now, there's all sorts of ways to reinsure. All right. That's why I do believe in buying options sometimes. Lots of times. All right. And so this is really how the two compare back and forth. All right. So let's look a little more, a little deeper. All right. So in section 1, you've got market selection, pricing, strategy selection, and time frame. That's the underwriting and pricing. All right. So what do you want to trade? What's a good price? What's the right strategy? And how long do you want to be in the trade? Setting the table. Then there's reinsurance and claims processing, that risk management, position sizing, money management, trade adjusting. All right. Buying options, disciplined closing of positions, and of course, portfolio diversification. So now trade execution, route selection, strike selection, complex versus individual orders, and of course the investment operations is the totality of this. Real simple, but this is how I teach people to think. All right. You want to go down the line. You want to be emotionless. I know a guy, his name is Larry, and he has never had a losing month, ever. No, they don't really. So the question is, do vertical spreads represent reinsurance equivalent? No. Well, kind of. They can. So if you're short a lot of vertical spreads and then you buy some vertical spreads, so if you sell put spreads and then you buy a few put spreads, that's reinsurance. Anyway, back to my buddy Larry. Larry has never had a losing month ever. He is a very wealthy individual. And the reason why he never has losing months is because of this approach. All right. He is mechanical. He is like a machine in how he manages risk and approaches every trade. There's no emotion. All right. So now let's talk about what markets to trade. First, how do you tell if an option is fairly priced? All right. Remember, insurance brokers sell overpriced policies. All right. So you're looking for an overpriced policy. Are most of the inputs of the option model are known at the time of execution. So when we execute the order, we know almost everything about the option except for one piece. All right. So insurance companies use actuarial tables to compute rates. Back in the day, they have you are 36, you are non-smoker, you are married, you have kids. This is your auto insurance rate. All right. Oh, you got in an accident. Now this is your auto insurance rate. All right. Really simple. Option traders, we use the option pricing model. All right. Black-Scholes, for example. And that uses the cost to carry, stock price, strike price, timed expiration, and forward volatility. I like to call them the 5 factors. So, you've got the 4 food groups, you got the 5 factors. All right, so you've got to understand how these factors work. So, cost of carry. Cost of carry can get tricky. There are pieces of it that can be tricky. You really have to understand it. All right, but that being said, most of the time we can figure it out. All right. the strike price. Again, if you can't figure out a strike price, leave this webinar and email me, and I will give you an intro to options course that you can I'll send you to an intro to options course. All right, stock price. All right, now if you can't figure out the stock price, that's worse than not being able to figure out the strike price. All right, so timed expiration. It's a ticking clock. It's a moving target, but it's something we're aware of. All right, then there's forward volatility. All right, now a lot of people think that the option pricing model uses implied volatility. All right, how many people think the option pricing model uses implied volatility? Yeah. Well, that is not its intent. If you read the model, it's supposed to run forward volatility. All right. So here's a question. Does anybody know what the volatility of Apple will be for the next 30 days? No. So we've got this pricing model that basically is worthless. So that's where we get implied volatility. Implied volatility is actually an output that then is put back in. So basically, it's obviously, we take this, plus this, plus this, plus this, and we solve for this. It's not algebraically, but that's basically what you do. So you say, okay, and we say, oh, this option is trading $4. We know these factors, and then we solve for this. That's implied volatility. And then we take that implied volatility, we then plug it back into the pricing model, and then it spits out the Greeks. Now, does that sound like a reliable piece of equipment? Would you fly an airplane where you had to solve based on your movement for how fast you were going? Or you had to solve something in the wing. Would you want to get on an airplane that didn't have a land speed meter? No, you do it not. I got a heck no, which I love. All right. Well, we trade options every day, not knowing what's going into what one of the major pieces of the price. So take a look here. All right. This is implied volatility is the red line. And 20-day realized is the blue line. So the blue line is historical volatility. So it's looking backward. All right, the blue line looks backward. So this is this way. Meanwhile, the red line is forward looking. All right, so if you look at some of these peaks here. Do you ever, and even some of the valleys, and then you look ahead. Does it look like the model does a very good job of pricing how much an option is actually going to move? No, it doesn't. Implied volatility is terrible, but it's all we have. So understanding the limits of implied volatility when it's wrong, all right? Recognizing when implied volatility is probably wrong is key. There's an old saying, garbage in, garbage out. If you don't understand the implied volatility you're using, you don't understand your model. There's also IV rank. What then do we do, Mark? That's what I'm here for. Yeah, I mean, all right. All right. At the money, implied volatility is the market's best guess for forward volatility. All right. It's not usually right. All right. It's usually wrong. It's usually overpriced by some. All right. At any given time, you know, I like to say that, and we'll go back here. At any given time, I like to say that implied volatility, you know, across all of the option sphere, I like to say that options are overpriced about 50 to 60% of the time. All right, so if I pull one option randomly, there's a 50% chance that it's too expensive, either a little or a lot, usually a little. All right, I'm not. All right. So this is a program that I use called Live Vol Execution, and this is what I use to trade. This is it basically. At any given time, about half of options are overpriced. It's not hard to find options that are overpriced. All right. Why is IB too high? Market makers know most retailers are buyers? No, it has really nothing to do with the retail audience. But if you think about it, most of the world is, you know, in anything, right? You do extra for good measure. Does that make sense? You know, think about it. You know, when you're taping up a package, right? Do you put an extra piece of tape on just to make sure? When you are, you know, buying, you know, when you've got company coming over, do you buy extra forks just in case? You know, plastic forks and plastic knives and spoons. It's the same concept with options. Most of the time, the market has bought too many plastic knives and forks and plates and paper plates. All right. So that's actually the key. All right. How would SIBO graph of historical vol and implied vol work versus fly vol? They're very similar. Why is historical volatility needed when we're looking? Ask me that at the end. That's a good question. Yeah, SIBO. I use the SIBO indexes are fine. The problem is you can't get a good vol on Facebook. So. Yeah, I mean, everything's a little overpriced. So at any given time, the market's about 50% overpriced, about 30% fairly priced, and about 20% underpriced. And your goal is to buy that 20% and sell the worst of that 50% and match them up. All right, I just bought an extended warranty with the new range. Oh, that's not the extended warranty. So, sorry, if you take a look, you can see this kind of red line gives us an average. You can see the peaks are much higher than where volatility actually goes. So look at these peaks at those 30% marks right here and here. Volatility never gets there. All right. So finding overpriced options. Look at the realized volatility. Look how much this the underlying is actually moving. Look how much it usually moves. All right? Understand where the volatility is. All right? Then look for a trend. Is volatility rising? Is volatility falling? You know, there is definitely a trend in implied volatility and realized volatility in this name. All right, now, all right, is the policy too expensive or too cheap? All right, so is there a trend in volatility? All right, so is the underlying picking up in movement or declining in movement? And how are the options pricing that? That's the first key to understanding whether the policy is overpriced or underpriced. That's the first step in trade selection. What to X? All right, what is current realized volatility, the SPX? So how much is the market actually moving? All right. All right. Make sure you look at past volatility in the right way. Use the right eyes. Look for outliers. Look for events. All right. And then ask yourself, will the last 30 days be as volatile as the previous 30 days? Or will the next, excuse me, this should say next. Will the next 30 days be as volatile as the previous 30 days? All right, so these are the things you need to be asking. So you need to actually spend some time interpreting where is volatility and where is it going. And I hate IV rankers. All right, and I'll tell you why. Most of the time, when implied volatility is low, do you think it should be bought or sold? What do you guys think? When IV is low, is it usually a buy or is it usually a sell? Now, I mean low in its IV ranker. We got a lot of people saying buy and a lot of people that are wrong. Sell low vol, buy high vol. That's kind of really the tradition. All right, now, within ranges, that's not true. But when the VIX is breaking above 30, that is the time to own it. When the VIX is falling below 15, that is the time to be selling it. Most of the time with volatility, you want to sell low and buy high. To a point. I'm sure that surprises people. Most of the time, you want to buy high and sell low. All right, so the question is, if it's low, shouldn't you buy? If it's at its extremes and it doesn't belong there, and it's low relative to its actual movement, yes. But just unilaterally looking at implied volatility and saying, oh, this is low, all right, is no. And I want to add some caveats. There's a lot of times where you want to buy vol when it's really low, but that's conditional. Most of the time, low vol is a sale. You want to buy IV when it's lower than realized volatility. Yeah, so when something's moving around, that is the time. Now, directionally, and this is for kind of non-directional delta playing, all right? Now, I will buy options when IV is really low and I'm making a directional bet. Yeah, see it now. Market has had low vol for several years and has been a good sale. That's exactly right. Shouldn't you sell when IV is closer to a 52-week high? Well, then 52-week low. No, because one of the problems, if you look at the last year when the VIX got really high, all right? So I'm going to go off on a little bit of tangent here, but I think that we're making an important point here. All right, I'll start this up in a second. All right, now I want to show you some stuff. So let's look at like the SPX. The SPX is almost always overpriced. I'm going to switch screens here. All right. And we'll look at a chart here. And we're just going to look at vol. We'll look at some volumes. And we'll go back to like the last time it really spiked. All right. And what I want you to notice, and this is one of the problems, all right, take a look at the real spike in volatility. It was higher than kind of where HV went at its peaks, but over kind of the life of it really wasn't, and especially for indexes. And what's the other problem? Take a look. So you're going, oh, look at how low the VIX is, right? Or look how high the VIX is. Look at where volatility is. It's exploding. All right, now, if you are delta adjusting on a daily basis, this is a great sale. Most of you are not doing that. Most of you are trading condors here, correct? Condors or something along those lines. Well, take a look at the speed with which the S&P 500 bounces out of these big peaks. Take a look. It's a 3-day move. You think short call spreads work really well here? You might get a put spread, but that's a directional opinion. All right, so if you can sell a put spread here, by all means, sell a put spread. Problem is, most people are so terrified here because they've been selling stuff up in here. Most of the time, people are selling here and are unable to sell put spreads and are unable to sell put spreads here because they're scared. And the problem is, you get kind of here and you get kind of a rocket. The VIX has a natural low because of monthly roll and SPX options. Ask me that later. So the point is, look at the rocket ship out. So if you're an iron condor seller, if you consider yourself a volatility trader, good luck with that. This is a perfect time to be like short a time spread. I want this. Poor premiums are great. It is I'd rather get a low premium and keep it than get a high premium and blow it. Someone said low VIX means low premiums. So, take a look at how this thing moves. You get these ebbs and flows. So what the stuff you're looking for, here's where I see an overpriced option. All right. So you've got the VIX hanging around 14 here. And you can see volatility has dropped off in the near term in terms of how much the market is actually moving. All right, so now the periods of data you should look at. All right, 10-day HV is too short to evaluate actual movement, but can give us a clue into what has actually happened recently. All right, was there an event that just happened that is affecting HVs? 20-day HV is 1 month of trading data. All right, remember, HV doesn't keep track of Saturdays and Sundays and days off. All right, it's good for looking at what the market is actually doing. 30-day HV has less noise than 20-day. It's good for traders who trade more part-time than full-time at seeing current trends. All right, and 60-day HV, 60-day historical volatility, gives us the best picture of current long-term trend in the market. always look at a price chart to see if there's something not coming through HV. All right. So what's the problem with most historical volatility? A lot of them are like Garch, where they look at close to close changes. All right. Well, what if we're getting huge intraday movement? That is going to cause all kinds of problems for your trading. So realized volatility. Falling versus rising realized volatility is going to be the #1 determiner. All right. It's going to be the #1 determiner for how strangles, condors, and credit spreads perform. All right. Implied volatility is the other portion that determines the success. So if you are a condor trader, you want to sell an iron condor into or a strangle seller. So you're Karen the super trader. Whatever. Yeah, Karen the super trader. The #1 thing you're looking for is sinking movement. You want to sell into sinking movement. Credit spreads too. All right. You're a credit spread trader. You want to sell credit spreads when movement is falling. The next piece you then look at, so you find something where movement is falling. Then you compare it to where the implied volatility is. So start with movement, then go to implied volatility. And that's where you're going to figure out whether to buy or sell. All right, so implied volatility is how much the market is expecting the market to move over a period of time. It mean reverts over the long haul. All right, it's more useful to look at relative median than relative mean. All right, use the exact durations to look for what's going on. 30-day IV is what might happen soon. 90-day IV is the market's longer-term trend. Here's an interesting piece. If you were only long the market in the S&P 500 when 30-day implied volatility is lower than 90-day implied volatility, you would absolutely crush the market. Absolutely destroy it. So if all you ever did as a system was go long, hold long stock, and then when VIX rises above VXV, you sold futures on a delta 1 basis and then took them off when the futures got back, or when VIX fell below VXV, you would absolutely destroy the S&P 500. Just about every hedge fund manager on the planet, you'd kill him. All right. So use the exact durations to look at what's going on. What is happening soon? What is the long-term market trend? IV and fair value. All right. Implied volatility is the market price of volatility that buyers and sellers of options are trading. It brings the volume to equilibrium. That's the fair value. The trick is fair value changes as IV expectations change. All right. So you should have your own internal fair value on top of the market. All right. I can look at an option and say that is probably too cheap. And I can look at an option and say that is way too expensive. All right. It is pretty simple once I get used to it. Once you get used to it. So here's implied volatility of the SPX. All right, from last year. All right, so what is the trend? Where is it going? Where will it settle? Well, we can see at this point we had a shock. Something was going on up in here. And IV is trending a lot lower, faster. So here's a question. We've just come from here, and I get to here. Do I want to be selling an option or buying an option? Well, if you just look at here, you're thinking, oh, I should buy it. But then take a look at all of this. Take a look at that. That is well below, this would be high for almost an entire 2-year period. This guy would be high for this almost this entire period, sans 4 days. You like my laser pointer? So that's expensive. I believe this is as maximized as I'm going to be getting. Which screen are you guys? I just want to make sure you guys are looking at the right screen. Oh, you guys are looking at the wrong screen, that's why. Duh! Sorry about that. I was on the wrong page. All right. All right. And then, someone said use an IV raker. Well, where would this rank in IV? Middle of the road. It wouldn't pop, wouldn't drop. Because we know IV can get down below 11. The only thing I really like IV rankers is finding really, really low vol. I don't trust them for high vol. The one scan I do use, I'll show this to you, is one of my favorite scans. I like to find IVs at a 52-week low and kind of see what's there. Buffalo Wild Wings. That's a pig. That's going lower, I promise you. All right. So the number one determinant of straddles, butterflies, and debit spreads. So buying and so straddles, flies, and debit spreads, things like that, is implied volatility. So what is your actual purchase price? Secondarily, so you say this looks like an expensive option, this looks like a cheap option, and then look at, so this volatility is falling, this volatility is rising, then, only then, go look at the realized vol. How much is it actually moving? So if you're looking to buy or sell straddles, first thing you look at and look for is falling implied volatility. Then look at the movement. All right, now let's talk about term structure. We all know what term structure is. It's the relationship of one month to another month. All right, using implied volatility, look at term structure. Is 30-day IV below or above 90-day IV? 30-day vol lower yeah, someone's here, I'll show you. So this, see these different volatilities? June, July, September, December. This is the term structure. All All right, so when 30-day IV is below 90-day, the market is in a contango. That is a calm market. It's a logical market environment. All right. So when the market is in a contango, all right, that is when your assumptions are more likely to work. A calm market is one that is manageable. All right. So you want your assumptions to work. That is a calm market. If IV is in backwardation, so 30-day IV is higher than 90-day, the market is less logical. It's more reactionary, less likely to hold any trend. Assumptions are less likely to work. And if you don't have something cool like Live Vol X, use VIX and VXV. VXV is 92-day volatility. Now, within contango and backwardation periods, there are times where one option seems underpriced in one month or another. Look at current mean relationship levels. All right, if the VIX has been trading at 1 point under VXV for the last 90 days and moves to 2 points under VXV, something has changed. A trade is developing. In normal periods, supply and demand create trades. Traders looking to traders looking to sell premium or buy premium can really move around volatility. Term structure, so how the different months interact, is going to be the #1 determiner for how calendars, time spread, diagonals, and double diagonals work. So I've now given you for all the major trades that you like, I've told you where to start and then what's next. All right, so I want to sell strangles. Look at realized volatility, then look at the implied. Then look at term structure. I want to buy a straddle. Look at implied volatility. Then look at the realized volatility. Then look at the term structure. I want to do a calendar. Look at the term structure, then implied volatility, and then realized volatility. So here's Facebook. Look at that sinking realized volatility. And I would say it's got a consolidating, let's look into coil here. I wanted to go long. So you can see volatility, realized volatility is falling. Implied volatility is about as low as it gets. Sans a little pop here. So I've got a relatively stable market, but kind of bouncing off a floor. So I think it's going to rally up to that 200-day. I've got falling realized volatility and low implied vol. And where is implied volatility really low? The longer term stuff. So now here I'm going to walk through a checklist of how I evaluate the trade. All right, what is the price action? It's bouncing to 80, I think. What is the best trade for the HV? HV is falling. In falling HV, what do I want to do? Do I want to buy options or sell options? Sell, right. Now, the IV is super low, 2-year low. All right. And the term structure is relatively flat. All right, what is the best trade for the term structure? It's in a small contango. So I have low IV, falling HV, and a small contango term structure. What trade fits best? What do you think, guys? Not that easy, right? There are a lot of pieces of this puzzle. When I examine term structure, I'm looking at Facebook's term structure. Not that easy. So I want a trade that does well in low HV, but has exposure to the long IV. I do. But is not going to be over penalized by term structure. So I would probably look at a diagonal spread. I'm long some Vega, I'm short premium, and less term structure risk because of the difference in strikes. So this is the trade I developed, a diagonal spread. And what I like about it is if we get a drop and IV rallies, I don't lose money. We get a rally, I make money. And you can see I was doing like a Feb March, like a 1 month spread. A bull put spread would have been fine too. All right. So in summary, insurance companies make money selling options. Option traders have to find premium that is trading for more than it's worth, learn to read price, HV, IV, and term structure, and use the information the market is giving you. Now, my boot camp. All right. Next month from June, it's going to be June 9th, 10th, 11th, and the 13th. I'm doing my 4-day boot camp. It's about 9+ hours of education, give or take. And it is really meant to take option traders that kind of, you know, if you feel like you're on a scale of 1 to 10, this boot camp is to take you from a 2 or a 3 up to a 6 or a 7. And if you're a 4 or 5 or 6, you will get stuff out of this. It's normally $500. I'm doing it for $247. And I'm going to cover using options to generate income, and then I'll look for some trades here. We'll take a look at a couple of stocks here in a second. But I want to tell you about this offer. All right, because I'm going to throw in something special here. All right, I'm going to teach you about the wheel. We're going to talk about how to increase profitability of directional trades and spreads, how to extract more dollars from the market, how to execute trades properly. I'm going to teach you how to sell premium through delta neutral trading. So I'm going to dig into each trade. What are the hours of the boot camp during the market? It's in the evening. All right. So the boot camp is usually the boot camp is usually going to be at 7 o'clock Eastern time or 6:30 Eastern time, and we'll record all of them, and you get to keep them. And then there's one at Saturday morning. All right. So we do Tuesday night, Wednesday night, Thursday night, and then Saturday morning. It's June 9th, 10th, 11th, and the 13th. And of course, it's recorded, and you get to keep the recordings. All right, and it's $247. But if you sign up by the end of the day on tomorrow, all right. So if you sign up by the time I close up business tomorrow, which is going to be 5 o'clock Central, all right, I will rebate $75 back. All right, so Sign up by the end of the day tomorrow, and I'll rebate $75 back. You'll see the rebate come on the 25th. All right, and I'm going to give you, this was very, we did some overview stuff, dug into some specifics on term structure. This is going to be very, very specific. And all of our courses that you pay for are designed to be standalone. They obviously are symbiotic with other courses, but they're not designed to be, I don't give you enough to actually trade off something. I don't operate that way. I don't do the carrot on the stick. The carrot on the stick in front of the horse. It's not how I operate. Go to optionpit.com/bootcamp. That is also where I'll post the replay. All right, any questions now about the presentation or the course or anything? You're welcome. Oh, it's done online. You don't have to be in Chicago. You do not. So it's all done online, and you keep the recordings. But I am in Chicago. Yes, $172, so about $20 an hour. That's cheap. VIX natural low via the SPX roll. No, the VIX is naturally the VIX is naturally low because there's a certain point where it has to have some movement. All right, so no matter how, unless the SPX literally moved zero multiple days in a row, it is impossible for volatility to go to zero. There's always some volatility, and that creates the natural roll. It has nothing to do with the monthly roll in SPX. Sure, I'm going to show some examples. How do you calculate term structure? Real simple, it's just kind of looking. So a trade I'm looking for in term structure is when near-term volatility is higher than long-term. So let me find an example here. Oh, all right, they rally vol there. Let me find something. So I might go. So this is where I might use a scanner. And again, this is all free with the execution software. So I'm not doing anything crazy here. This is just professional grade software. So I would go to implied vol. I'd look at some of these low vols. And I'm gonna scroll through a few of these to see if I can find something interesting. All right, so here is, do I take VIX into consideration at all? VIX has been historically low for a long time due to quantitative. I don't think it's just quantitative easing. All right, really the VIX is only traded below 10 on 9 days total. You do not. I will rebate the $75 on the 25th for everybody that signs up by 5 o'clock tomorrow. So it's a rebate. It is not a coupon code. So here is ISRG, Intuitive Surgical. And you can see range bound, super range bound, I don't know what you call it, HV, you can see HV sinking some, but look at where IV is. implied volatility is about as low as you're going to see it. But I don't know when it's going to pick up. You can see the two of them are kind of on top of each other. So now I might go into this term structure now and I look a little deeper. And I see May and June. Take a look. All right, the June 5s are 19.7. And the June 26s are 20.07. So that's almost as flat as you can be. So I'm buying low vol. Do I have a trade alert service? We do have what's called a strategy letter that we follow along with. So basically, we enter trades, manage them, and exit them. We don't call it an advisory, but it is it's an extension of the education. But some people might say it's an advisory. Yeah, this is perfect calendar spread. That's exactly right. I think a calendar spread makes a ton of sense, or a double calendar. So you've got ISRG trading 492. So I might do like the 490. Oh, do I take option volume? Of course. You know, not too much. I mean, this is these are wide markets, unfortunately. And weeklies can be difficult to trade sometimes. We go to June. Do the 497 there. So this is the, I might do this as a double calendar, leaning a little long. $7 for this double calendar is, on a $500 stock, is disgustingly cheap. If I could pay $7.50 for this, I would probably, this I might look at tomorrow during the pit report. When I examine term structure, I was looking at the money. Well, the term structure that I'm pulling up there is kind of similar to a VIX. So ISRG is kind of interesting. Something that's maybe a little something that moves a little more. I might want, like, all right, Zillow's toast. That's one I would just buy puts, and I absolutely. So then. That's something I would scan for. All right, now, in terms of kind of strangle trades, things like that. I actually think Apple's made a nice move. So let's take a look at the movement. Or actually, you know what's a good one? One that I think is a great iron condor trade, or strangle trade, or straddle even, or butterfly. So take a look at oil. How about a vol crush on something like post-earnings CRM? The day after earnings can be one of the best times to sell options. Just make sure they don't get oversold, because a lot of times that happens. I think USO is the butterfly-y, iron condor-y trade of the year. I did one in, you guys all see my show Track the Trade? All right, I did one on USO right here. That was from April. I actually took this one off. So that's another one that I really like as a potential trade. All right, guys. I think that's been a nice run. Yeah, I know you have. Been a nice run. Now, if you are a gold member or if you are a gold member, this is free for you. So don't worry about that. Thanks, Robert. All right, if you got any questions, feel free to. All right. How many hours per night? It's probably going to be somewhere between probably about 2 hours, split into some pieces. What piece of software are you using for that Pro Scan? LiveVol X. When IV is low, buy options. When IV is high, sell, plain and simple, right? No, other way around, typically. Or find smart ways to buy options when IV is low. See, I don't mind buying options when IV is low, but I'm going to finance them. Do I need membership for LiveVol access after the training? You do not. LiveVol is free if you open up an account with their. Mark, what level of trader do you recommend for boot camp? I would say like I said, anybody that's a 3 or higher. All right. And LiveVol is free if you open an account with their execution services. So it does not cost. And if you want information on LiveVol, I'll hook you up with people. My customers get preferred pricing with LiveVol that normal people do not because of my relationship. Too complicated for a newbie? If you're really new, I would probably start with my silver program, which is like 147, I think 147, and you can get that at optionpit.com/mentoring. All right, guys. Everybody have a great evening. I'll get this posted tonight. It'll actually be posted on the bootcamp site tonight if you want to watch it again. Everybody have a great evening.